Good evening. This is a little bit new. Zoom changed their format, so this is a slightly different start screen for me. Um, well, as far as I know, this is my 100th closed-end fund video. At least that's what I remember from last week when I made the 99th video. So, um, yeah, I'm going to change a few things. So, change the title, um, talk strategy. I had some people contact me and give me some feedback, which I like. That we haven't talked strategy in a while, haven't really got into the ins and outs of closed-end funds in a while. Uh, and that's good to know. And it on my end of things, it made me go back and look at, I mean, I keep notes of all the different videos that I've done. I don't watch my own videos, but I keep notes about the videos that I've done. And I realized they were right. I mean, outside of the strategy session, uh, middle of November, been a while since I've deep dive strategy and closed-end funds, and I'm not going to do that on this video. I'll be honest about that forthwith. I'm not going to do it on this video, but I do have something in the works. I've been working on making a case, or I guess I've been working on the text or the outline for making the case for closed-end funds, but it's also making a case for how to use a Roth and using that with closed-end funds, and then that led me into really separating. I wrote the first one, and it was kind of jumbled and crammed with, I don't want to say random stuff because it's all stuff that needs to be talked about, but at the same time, it was too much for one. So I divided. So I'm still working on making a case for a Roth using a closed-end fund. I'm also still working on making the case for closed-end funds and how to optimize your retirement. But that's for the future. So for now, at least how I'm going to change the title for this video, at least what I've got right now is how to use closed-end funds to optimize your portfolio and beat herd investors. And it's creating a no withdrawal portfolio. So you're not selling principal, but it's creating a no withdrawal portfolio that funds your life and then retiring easier, cheaper, and better than herd investors. And I know that's a lot for the beginning, but that really sums up the overall mindset that we're going with. We're building a bigger portfolio, or I guess we're building a portfolio. The goal is not to sell principal. Uh, we don't follow the 4% rule. We don't follow the 60-40 split. Um, there's better strategy out there. And selling, regardless of how you think the market's going to go, selling the principal balance of your portfolio every year just does not make sense to me. And I get into that on those other uh, videos, or I guess in that other content, but um, and if I divert it here, it's going to take a completely different route than where we need to go. But just realize the 4% rule is, from my standpoint, a faulty system. The 4% rule is you have 1 million invested, you're taking 4% out a year, 40 grand to live on. The problem with that is you're living on more than 40 grand now, and your money is going to be devalued at 4% every single year, unless something seismic happens. And it hasn't happened yet. I mean, if something seismic happens and the Fed is replaced and we go back on the gold standard, that would be huge. And we still have inflation to a degree, but not to the level that we're seeing right now. So on a 4% rule, you've got 1 million invested, you're taking 4% out every year, and the market gains 4% back. But it doesn't factor out 4% of devaluation through inflation. And you're living off of more than 4% now. And when you retire, you're probably living off more than 80 grand. So you're already starting out with a broken system. Uh, and that's the herd. I mean, that's the advice the herd follows. You're investing for stock market gains. You know, the idea that you would buy Apple and see a 10% increase over 5 years. Well, that's 2% a year. Inflation's 4%. So you're down 2% a year. Now you might be up in the sense that your shares of Apple might have gained 2%, or Amazon or Google or Meta, or pick your stock. right? You're up 2% of what you can see, but you've been devalued 4% of what you can't see. So you're losing already. And then, I mean, the average S&P dividend is like 1.12, 1.2, and it's getting paid quarterly. And we can crush that in the closed-end fund market space. We can crush that in the closed-end fund market space, and we can have better strategy. So if I divert more than that, we're going to talk a lot more about that than what we need to talk about. So, my name is Daniel Young. I am the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I do want to talk more closed-end fund and how we can optimize our investment strategy and look at our targets for the week. The disclaimers: this is an unedited video. Who knows what you hear? Who knows what you'll hear in the background as I film these in my house? My cat is roaming, um, and may or may not make an appearance. We'll see. I am not a financial advisor. I am a strategist, and I'm a financial strategist. And I don't speak like the herd, which I hope you can tell. I don't speak like the herd. These videos are riddled with mistakes. I misspeak, I mumble, uh, some like this. Like it's not a clean breeze all the way through. So I don't speak like the herd. I'm transparent. I'm honest, um, and I try to be unfiltered, professionally unfiltered, but I try to be unfiltered. And then I walk in limited company, and sometimes I walk alone. So, are there notes for the week? It's been a while since we've covered notes and updates. So, are there notes for the week? Yes, and I'm glad you asked. As it's been discussed again, Congress had been planning to spend more than 2 trillion more than what we already had budgeted, which shouldn't happen because the CBO, the Congressional Budget Office, is supposed to account for everything spent. And when Congress overspends, they either A, have to cut because they have to stick to a budget, but we all know they don't, or they somehow have to invent new taxes, which they always do, and those get buried in other bills. So Congress was planning to spend 2 trillion more than what we have collected in taxes, or what was budgeted collected in taxes. But Musk and Doge have been pulling the wool back on what the government has been doing with our money. Now, the government doesn't have money of its own. When someone says the government gave money or the US government gave money, the government itself doesn't have money. It's taxpayer money. It's our money. And Doge continues to find all this shit that we've been paying for and that the vast majority of the country, at least 77% of the country, completely disagrees with. And then that number grows weekly. And it's also skewed based on what poll you're looking at. So now remember, Doge, the task for Doge, amongst all the other stuff, the the initial mission statement was for Doge to cut at least 2 trillion from the budget in the next 2 years. And Congress was planning on spending 2 trillion more than what was already planned for taxes. Those numbers are not coincidental, right? It's important to note that Doge cannot truly cut spending. I mean, they can continue to expose the egregious spending and stop payment on existing spending measures. But really, if we want to cut spending, Congress has to do that. And we all know how hard that is to happen. But the more light that gets shined on that dark hole of kickbacks and insider trading and money laundering and crap we all just don't want, the more pressure the more pressure we put on Congress to act. Uh, let's see what else. Trump's tax cuts from the first presidency are supposed to expire this year. And all of this is happening at the same time. So you have Trump tax cuts expiring, you have Doge bringing to light all this nefarious BS. You've got Congress's budgeting track record being exposed. And then you have really all this other stuff that we're going to get into happening at the same time. And while the swamp and the herd are scared, I'm hopeful because the potential of decreasing our taxes and decreasing the size of government and reverting back to tariffs to pay for the government means more money in our pockets. And before you freak out on tariffs, If you've watched my stuff before, I mean, if you've watched for at least the last 2, maybe 3 weeks, we've talked about how tariffs do not increase inflation. That's the fear tactic being used on the herd. But data has proven tariffs do not increase inflation. What else? So with Doge, there we go, as Doge suggests cuts and more cuts to different departments, this enormous federal bureaucracy is downsizing. And of the reported 20 million plus official and unofficial government employees, think about that. Like, really think about that. There are like 135 million eligible voters in the US. 20, if not 25 or 30, are supposedly government employees. And they voted to, keep the bloat flowing. But just think how many employees that is. Now, non-government employees mean like you're a third-party contractor, right? Non-governing organization. You're getting government kickbacks and payments and taxpayer money one way or the other, right? But that's an enormous bureaucracy. So of the reported 20 million plus official and unofficial government employees, 105,000, which is not a lot, but it's a start. 105,000 have recently left their jobs. And as more jobs are cut, our labor market is going to soften, meaning we're going to see a brief increase in unemployment while more people are looking for new jobs and more people are filling those new jobs. Now we have jobs available. May not be the jobs they want, but we've got jobs available. We're going to see more people looking for jobs, not because of yeah, that's my cat in the background. Not because of anything else. It's just that that's my cat knocking something over. Um, but they're getting nicks from the government, so they're going to have to find a job somewhere else. You've also got certain congressionals bemoaning the cost of eggs, which they weren't really concerned about before Trump became president. But you and I both knew egg prices were going to spike after Biden and company killed 500,000 chickens for no good reason. And their excuse was bird flu. But bird flu, my butt. I mean, birds with a natural immunity are making it, or so the birds who were making eggs that they killed contracted bird flu and beat the illness and now have a higher natural immunity to the illness. Those birds are making superior eggs to the birds who are still at risk, right? That's like the same thing for you and me contracting the flu. Like if you got the flu and beat it, now your immunity is better than before you had it. We killed all those birds. Maybe not all, but we killed 500,000 chickens. Go figure that egg prices would spike. So supply and demand dictates that with less egg laying chickens, egg prices would increase until we could recoup those chicken losses and start getting more eggs. But it's so weird that we've got congressionals who don't understand these things. But then we also have Congress spending more money than what we had and shipping it around the earth instead of investing it here at home. And here we are. And it honestly sounds like we could use some new congressional leadership that actually cares about us and not just the insider trading and lining our pocketbooks. Uh, what else from the last week? Stocks are dipping a little bit, and we've encountered part of that looming tech bubble. I don't think it's over. I don't know if it continues to dip down or if we reach a lull, like it responds back like it normally does, and then it dips again. But tech is still puffed up, uh, but it's getting depressurized. That DeepSeek AI revealed a little bitty prick in the bubble initially, but we've also seen more fuel getting added to that AI party with more players producing cheaper AI. I mean, just last week, Alibaba said they came out with their own DeepSeek spinoff, and we're going to see more of that. Now, you can argue that it's not going to compete with the US, but at the same time, regardless of how they're getting chips, regardless of how they're implementing the technology, if somebody can do it cheaper, companies like that. I mean, now on the flip side, the US is going to go back to pride in American product. So if it's getting produced outside the US cheaper, it's going to incentivize US companies to make it cheaper as well. What I don't hear a lot of is no, I really don't hear anybody talking about the long-term outlook on oil and oil production from Trump's drill baby drill program and how that's going to make the production and transportation of technology, so the end-to-end business model, right, a heck of a lot cheaper. Oil is required to make uh, computer chips, right? And then you have to get that computer, you have to process that computer chip, and then you have to get it from where you make it to where it needs to be. Oil is required for all of that. So if we have a greater abundance of oil that's cheaper, it should drive down the cost of technology and drive down cost to consumers. We haven't seen that deflation yet because it's honestly just started. There's been talk of it for a while, but that energy strategy, I guess, or that new energy independence boom has really just started. But if you're worried about volatility now, right, that should certainly stir the pot going forward. Other things impacting the market this week. The Fed quietly ended their QE, their quantitative easing, or pushing money into the market. They finally ended that, which is why I think we're seeing the dip. And that makes sense, right? There's more to it than that. There's more. You've got DeepSeek and Alibaba. You've got other things controlling the tech market overall. You've got the housing market, the overall rates. There's a lot going on. But when the Fed had to pull back money, so the Fed has been propping up the market, right? You can't just tell me it's a coincidence that the Fed's attempts to manipulate the market and that being stopped don't coincide with the recent lull in the market. So let's see. I have notes on this, and I hope I'm not making it muddy. It's the economy seems to be slowing, but why is it taking so long to slow on paper? Like we've been talking recession for at least 6 months, if not a year, right? And the possibility of a real recession, or the possibility of a no landing recession where everything dips, but the economy just keeps going. But with the Fed pushing more and more money into the market, they're bolstering the numbers and they're bolstering the data. But now that they had to pull back and end quantitative easing, meaning they're not printing money and pushing money into the market, it's like a pillow fort or a blanket fort. You've got all these little stakes, right? And the blanket is dipping in different places. Well, all of a sudden you take a stake away and the blanket dips. That's like the Fed taking away quantitative easing from our stock market fort. Now, everybody knew, well, I won't say everybody. The swamp itself, I still think the swamp itself hoped that this wouldn't happen. But outside of that, everybody else knew best that the new Treasury Secretary would have a different outlook than Janet Yellen and how to go about helping the country and the economy. And we desperately need that different idea or that different opinion, that different vantage point. Right? Had the Fed gone on printing, we'd still be dealing with inflation that didn't go away because the Fed is quietly printing money, right? And we'd have stagnant rates because the Fed is quietly printing money. Now, think of this. We have inflation because there's too much money in the market. Things are being devalued. The Fed is saying that it's pulling money out of the market, but at the same time, they're quietly printing money and pushing money into the market, right? So they're perpetuating their own game. They're propping up the system. Now that they've had to stop, right, it's going to drop a little bit. And Powell's looking us straight in the eye. And it's like, look, inflation's sticky and rates are going to remain as they are, but inflation's sticky because he's printing money. So the other thing we have to contend with in the secretary in the Treasury Department is Janet Yellen didn't refinance the U.S. debts when we had record low rates, and I don't know why. Like it doesn't make any sense not to refinance our high rates at a low rate unless you want to sink the ship. So that leaves us in dangerous waters. Bessett's got to do something to counteract the debt. And he's making moves. He's willing to make moves that no Secretary has been willing to do, calling for accountability. And I think Jay Powell might have stumbled a little bit on that. He's been able to do whatever he's wanted to do and silently control the economy. Print more money, pull money back. Talk one way, do another, right? Pump money in, pull money out. But he's not used to a Treasury Secretary who's willing to do the job. And how that looks, let's see. You probably end up seeing my notes for a little bit, but there's no way around that, really. Let's see. So I took some snippings earlier today. Let's see if I can get to these without too much issue. There we go. This is from the Contrarian Outlook. You see my notes on the side. Um, right. So just a review of things, right? So you can see the highlighted parts. You can pause the screen however you want, but it's tariffs don't boost inflation, right? And then the rising prices require a hot economy. Trade war does the opposite. All that stuff, right? What they're talking about is a slowing economy in this chart. And I mean, I highlighted the recession part, but it still makes me think of the Fed and what they're doing with the economy and the market overall. If the Fed is pumping money into the market, right, they're talking about pulling money out, but at the same time, they're propping things up. We end up with this pillow fort, right? Stakes in the blanket, not even. Well, all of a sudden, they pull money out of the market, right? Like that program ended. And then all of a sudden, we have a dip. Now, how far we dip, I don't know. I like stuff that comes out of this group, but how far we dip, I don't honestly know. So, in reaction to that, in reaction to the slowing economy, the bond market responded, and that goes along with Bessent's ideas, right? So the 10-year yield on where are we? The 10-year yield on the U.S. Treasury notes has fallen, and that goes with this. Investopedia has really great stuff, and there's a lot of stuff above this that talks about the 10-year Treasury yields. But what I wanted to talk about mostly was this. So everybody everybody looks at that 10-year Treasury yield and how it seems to indicate different events and different sentiment inside the US market and even outside of the US. It doesn't really impact Europe or Japan and all, but at the same time, since the US is seen as a wealth building system, it actually does indirectly impact those other countries and their markets. So this part at the end, a declining yield would indicate that investors like you and me are seeking safety amid economic uncertainty, which can be a sign of anticipated economic slowdown or deflation. Now, we want deflation. We have inflation. We want deflation. But think of how to say this. it's important to know. It's important to know how to sift articles. It's also important to know that the herd, the herd itself, like if you watch Shark Week and Migrating Fish, you'll see all of these little bitty fish congregated together in this giant, um, so strange. I draw a blank right now, pool of fish, um, and they are diverted off course at the merest hint of trouble. It's kind of like shark on the horizon, and they all go this way. And then you end up with this on the other end, and they all go that way. That's like the herd in the stock market. School. There we go. The school of fish. All right. I mean, you get my mistakes as well as whatever else I say. And you have this herd of people who's following the overall sentiment of the market, like that CNN Fear and Greed Index. And the general herd investor seeks safety when the economic turbulence gets way too high. It's like that giant school of fish getting diverted and running to safety wherever they can find it. That's not the best strategy, but that's the herd. The herd gets steered. And I say this again, I mean, the herd gets steered wherever they are told to go. It's whether it's somebody who doesn't know a lot about the market and somebody else is investing for them, whether it's a lot of new money in the market, right? Or whether it's just somebody that loves the news and loves whoever else is telling them to do something. You have this giant body of people who's actually steering the market, and they are getting steered into every single fearful situation possible. They're also, like, when it's a greed rally, they are late to the greed, so they further bolster the greed. And when stuff like this happens, you and I have been paying attention. So we've been in bonds for 6 months, 12 months, maybe longer. And the herd is just starting to sniff fear and they're turning into bonds. Now, we've talked about this for a while. They should have been doing this for a while. Maybe some have. But the more stuff like this ends up in the news and the more things uh, the herd itself kind of senses, we're going to see more people steer their way into bonds. See what else? So the bonds. So we have this somewhat slowing economy, right? The yield goes down. People want a safe, consistent payer, and deregulation is what we want. Drilling is what we want, right? And then it talks about how that helps consumer pricing and really helps overall inflation. And then we end up with this brief snippet on Doge, but honestly, 105,000 people getting new jobs. Look, we wish them well, but at the same time, we need more of the government to get fired. Um, Less government, small government means more money in our pockets. And with the article I read today, uh, was it? Oh, what was the stat? It was fewer people today are planning on taking any type of summer trip for the first time in forever of at least of what the study found. And I would argue that's probably in the last 4 years because 4 years before that it was amazing. But fewer people are planning to take a trip this summer based on the current economic issue. And as one of our friends said it yesterday, inflation is crazy. The cost of everything goes up, and it's not like all of our wages are increasing. There we go. So, where does that leave us? Is there anything else we got to talk about? Yes and no. And I hope I don't sound like I'm rambling. That's really not my goal. Really want to kind of walk through different things and then how that impacts what we're investing in this week, or what we're investing in at the end of the month, or what we're investing in now for the long-term game plan. Um, so where does it leave us? Like where would I invest? Which let's get into that. So before I actually get into the week, let's get into something else that people ask for. Let me go back to sharing my screen. So these are our portfolios. And I zoomed the screen to where you could see, and you don't see the buy dates, right? The ex-div dates and the game plan. But you can see our buy-in price and then the overall, close to the overall. See, here. I know that's not the entire spreadsheet. That's maybe more of what you're looking for. This is what we ended up doing this past week. Of the individual account with Webull, I sold this fund for a couple reasons. Well, several reasons. One, I'm not opposed to a global fund at the moment, but I think the US is much better poised to do well, especially in the next 4 years, than anybody else globally. Two, global companies have more risk. Three, GLO had changed the format significantly. They were, from my standpoint, over diversified. They moved to a more portfolio in a can mentality, a little here, a little there, a lot more in other places, and the allocations they had for those a lot more other places were not well positioned for this economy. So knowing that I wanted to max out the Roth for this year, knowing that we want to move our portfolio from Webull into Fidelity, knowing that that gets harder, the more cash money that's inside an individual account. My goal was to sell GLO, let the money settle, transfer it out, and then transfer it into the Roth, so I could both max out last year because I have honestly, it's you have up till April 15th to max out your Roth contributions from the previous year or start a Roth for the previous year. So I can max out the contribution from last year, and then because that it was 65 last year is 7, um, and then I can go ahead and add a little bit for this year, and then it would position us to buy something inside the Roth and thereby decrease our overall cash money in the account before we try to also transfer the Roth to the Fidelity management system so that we end up with all of our accounts or all of our investment accounts under the same managing umbrella. Not so much because I dislike Webull. I actually like Webull's system. I like their display. I don't like how the system manages dividends and how it factors all that in, but I do like how it separates dividend payments and how it keeps track of them. It's so much easier to follow than the typical financial ledger that I've seen with Morgan Stanley and now that I've seen with Fidelity. I like the online system better, but to make it easier on my family, like if something happens to me on my end of things, I could deal with 5 different systems, but that goes with diversification, right? You're spreading your money out. If you have that much money to spread out, kudos. But if you're spreading your money out, it's really hard to grow money anywhere. It's like butter scraped over too much bread. It's also, it doesn't make it harder to manage on my end. It makes it harder to manage on my family if something happened to me. So to make it easier for them and easier for the system overall, the goal is to get all of our financial doings under the same financial management platform umbrella, just so it's all in one place. And the less cash in the account, the easier it is to transfer. So we sold GLO and I kept ZTR, which is still, I believe, a global fund, but I like how the fund is laid out better, a lot better than GLO. The Roth. I mean, between the Roth and what we've bought already at Fidelity, we're built for this market. And I read an article today that was, as you get older and grow your portfolio and you essentially start to dabble in different risks. Like it's almost like you would have a portfolio in a can built inside your portfolio so that you could weather the market however it is. And I get that. But quite honestly, if the bond market suddenly shifted and it was like all of this is going to tank, it would be stressful to sell all of this stuff. But at the same time, it's it's figuring out your strategy. It's figuring out your strategy and how much you want to be involved on the short term and long term end of things. If the bond market went to complete crap, the options would be to weather the storm and watch prices dip so long as they were paying a decent dividend, or we sell those funds high and we reinvest the money at the next flip of the cycle, right? So right now it's bonds and bond proxies, right? So you have bonds and real estate, you have bonds and municipal bonds and real estate and energy and utilities. If that shifted and suddenly became a consumer market, as much as I dislike the consumer landscape, then I would probably rethink strategy and figure out a different angle. Um, because in the no withdrawal portfolio, it's building a portfolio that can be sustainable, right? And so you're not selling principal, you're not worried about the rise and fall in the overall account value so much as it can pay you a sustainable dividend, right? But if the entire portfolio was scheduled to drop, right, or predicted to drop, I mean, you'd end up with a devalued portfolio. Now, if they were still paying a consistent dividend, that'd be great. But if prices drop that much, do you really think they'd be paying the same dividend? Probably not. Um, so our portfolio is built for now. It's not so much a portfolio in a can. You've got bonds and a mix of bonds. You have bonds, closed-end funds, precious metals, corporate bonds, business development, private lending, everything real estate. That is the portfolio in a can. But it's everything what we're looking outside of the little bit of consumer. It's everything we're looking at right now. NBXG is really the only straight stock platform I think we have in either account. Um, and I like how they're set up. OXLC is all collateralized loan obligations. RFI is real estate. And then Fidelity, it's almost a mirror image of the Roth. I left out NBXG because it wasn't a great buy in the current market. Uh, with an overinflated tech market, I felt no desire to pay more money than what it was worth and buy NBXG. Do I love the company? Yes. Do I like their dividend? Yes. But it didn't fit the metric. So we went with bonds. We went with this bond company instead of CIF because this bond company has a private lending feature and a BDC feature that works a lot better in this market than CIF. I still think CIF is a good pickup, but it's almost a roller coaster thing. And I don't necessarily enjoy the roller coaster, especially when it dips like ZTR and GLO. But I also bought CIF knowing it would be a longer term hold, hoping for smaller rates to where I would see their overall share price rise back to what it used to be, right? With our previous most recent experience in short term rates, and then before that and before that. So on the next rise, the goal would be to sell CIF and then roll the money forward into something else. But in this, not the game plan for that. I wanted more. I don't know how to say it. I wanted something that was more consistent. So not the buy and hope, I guess you could say. Although it's all risky, but not the same amount of buy and hope. So we still end up with BRW, so bonds, precious metals, CEFs, FCO, corporate bonds, private lending, BDC, same real estate, same portfolio in a can structured the way we like, and then three municipal bond companies. And as I look at our portfolios, there are options available if we wanted to add another fund. However, for what we have structured in our portfolios as is, I see no reason to add something else. To add something else would be like, is it better than what we already have? And starting out, we're not going to buy another round inside Fidelity until the end of the month, right? So this one, we're not buying anything inside of. We're about to transfer this to Fidelity and try to merge our platforms or merge our portfolios. We're not looking to buy anything here. And inside the Roth, so we're set up for bonds, real estate, that mix, tech. Uh, overall, yeah, it covered calls, but really they specialize in collateralized loan obligations and then real estate. And for the current market, that's where we ought to be. So to add anything means that it would have to be better than what we already have. And it's hard to, if we found it, would I invest in it? Yes. But I haven't seen that. I can't argue for adding anything new. Um, it's also knowing that of what we already have. Picking up 100 shares is a lot of money in a sense, but it's also like you're diversifying yourself for the sake of diversity, building that all weather, no withdrawal, self made portfolio and a CAM portfolio just for the sake of diversification. And it doesn't make sense to me. So, portfolio wise, this is what we have. And that's why on this master, everything is color coded. Dark blue we own in the Roth, light blue is the cash or individual account, green or olive, however you want to categorize the color, is what I track. Purple is recommended by somebody I trust, or whatever that color looks like to you. Purple. I don't know what else that would be called. Um, so getting back, let's see. So what would I invest in? Really, of what I've already covered: bonds, corporate bonds, and then the proxies. And it it goes with your comfort level. But honestly, volatility in this case is our friend because volatility and that 10-year treasury yield, volatility is going to push people into bonds, right? You and I have already been here. The herd investor will finally perk up his ears. That school of fish will finally go, crap, there's a shark, and they will turn, right? So when you factor in what's being called a slowing economy, I don't know if we'll truly slow down, right? I think we're back to more like a no landing recession, but a slowing economy and the country wanting accountability. Seriously, people cannot get enough of Doge. Everything I see online, there are a lot of people that want to silence Doge because it's not that they're saying the fraud and the waste doesn't happen. They're mad that Doge is pointing it out. Um, yeah, gosh, what are they finding? Trump continues to keep his promise to drain the swamp, but we're finding the bottom feeder system was so much worse than what we thought. We're finding that some congressionals aren't really mad about US aid misappropriating or misspending or wasting our money doing all of these other crazy random things like giving cocaine to fish to see if it makes them more violent or uh, what was it, giving cocaine to fish to see if it makes them uh, more interested in sex. Or maybe that was the monkeys, giving cocaine to monkeys to see if it makes them more promiscuous. Um, there's all this stuff that's getting paid for that makes no sense, right? And we have all these congressionals and people on TV and the propaganda news who are mad that somebody found out about it and told the rest of us. But we've got this slowing economy, a draining swamp, the curtailment of egregious spending. a colossal government getting reined in, Trump calling for Congress to balance the budget, which hasn't been done in gosh, at least in 2 decades, at least. But Trump calling for Congress to produce a balanced budget, a Treasury Secretary who's doing the job and actually made the Fed stop printing money and inflating currency while propping up our stock market pillow fort. And we're finally getting companies that are seeing the writing on the walls. If you take the Fed's money out, that inflated market's going to drop. And people overall are okay with that. The news is not, but people are, because in the long run, they still want the returns. In the short run, they're okay with Trump and Bassett and everybody else fixing the issues so that we see those long-term gains. But without that accountability, we'll see the US continue to default on debt. And you and I can't do this. I still don't understand how Congress can. Congress talks of raising the debt ceiling. That's essentially raising the max limit of your credit card, right? Like you can't raise your max. You have to call your credit card company who then approves it. Congress is just like, yeah, we agreed to improve. We agreed to increase our debt ceiling. Fuck that. We have that much debt. We need to stop USAID spending all this money. We need to pour, my gosh, cut spending, cut cut the 2 trillion, do everything we can to pay off the debt, because if we can do that, that puts money back in our pockets. But without that accountability, we will truly run out of money, and people don't want that. People get it. So we know the short run will be rocky and volatile, but most people will gladly deal with that as the rest gets sorted out. And in volatile markets, investors clamor for a safe haven. It's like the old school smoker commercials trying to get out of a building. Like they will fight hand over fist for a safe haven income. And if stocks are dipping, which they are, would you invest in consumer stocks? No, right? So the herd is running or swimming scared and getting steered, which I just love that pun. But the schooling herd is getting steered by all of these other fears into the places that we've already been. And that's perfect for us, right? Corporate bonds pay consistent monthly dividends, and they're easy to find in the closed end fund space. And though the discounts have been closing and the space isn't as populated as in prior weeks, because there's more people paying attention and more people invested, more people looking for alternatives, right? You've got the herd running scared and scattered, right? But for us, we've already been there. And once the herd itself, or once that school official overall goes, oh my gosh, look, I can get it over there. That's great for us because they close that discount for us. They raise the price. They eat more shares, which makes our overall value go up. We want that to happen, right? The trick becomes still finding the deal in the current market, right? But besides, if corporate bonds are the quiet bay we're needing in the current stock market storm, municipal bonds are an even better option. It's like the little cove or the little inlet to the cove. It's even further away from the storm. I mean, the default margins on municipal bonds are super low, right? So that leaves us with lots of good options in this market space. It leaves us with corporate bonds. It leaves us with municipal bonds. It leaves us with real estate and utilities and energy, right? And all of that awareness and knowledge is important because when we sort the targets for the week, that's going to help us sort the list. Now, the only other thing you could, well, you can make whatever case you want, but if your portfolio just screamed, there's a really great dollar cost average move, you could make a case for that. And for us, there is one. For us, it would be NBXG. And if we did it, it would be inside the Roth. I don't think I would buy it inside our Fidelity platform system yet because overall the tech market I still think is inflated, which you could be like, well, why buy it in the Roth? And I would, I mean, I could go back and forth on that, but I think there is a decent argument for us for doing it inside the Roth. We already own it. Uh, at most or at best, NBXG went up to $13.83. And I know because I track it, right? 10% of that dip price, like in a true tech dip, 10% of that price would be $12.45. And currently it's at 12.63. And it's not 10% off. It's like 8.6. So it's close to 10%. It's also about $1 higher than where we bought it. Like our current buy-in price average is, I think, 11.62. So at 12.63, that's almost $1 difference. That puts us at about a 50% overall increase. But compared to where it used to be, $2 higher, a little more than that, right? Now our share cost goes up. And it's tempting, right? Because we're looking at the market in the long term. And I get that there are a lot of companies, tech market is overpriced. We still have the updates coming in. AI is still huge, but we still have all this undercutting of AI, like somebody else can do it cheaper. So maybe it'll still go down. It's the timing of it, which you cannot time the market, but it's more so much the timing of your portfolio. Um, so I can make a case for it. I'll see how the week goes. But if we bought it and then tech continued to drop, the drop would suck. I mean, the whole point is to optimize the portfolio with the best deals in this market for the long road. And honestly, if I'm buying it in Fidelity, NBXG doesn't make the cut. But since we already own it and based on the prime price we have, it's tempting in the Roth. But we'll see what the week holds. So I've whiffled and waffled long enough. Let's get to the actual list. So I went through and updated the list today, about a week and a half late, but I got into why that happened on the last video, so I'm not going to get into that again. Of this list of triple asterisks, I already made a list for the week. And we're here. So every one of these targets has a significant discount currently compared to its historic discount. And our targets are still the same. We still have bonds and loans, utilities and energy transfer and real estate. Oil, if we can find it cheap, it's cheaper this week than last because of the dip, but not comparatively for our overall buy-in price. Tech, same way. Consumer, really just not on it's not on my radar. It's there in the sense that it's on this radar, but it's not on my radar. So all of these are filtered already by target. They're already filtered by discount. Ruling those two columns out, like they're important, but the next option would be we want consistent monthly payers, which means this quarterly one has to go away. And I looked at it, but it's really what it pays. And I mean, it looks like a changing fund. It looks like maybe the dividend overall might be going up. That would be great. But I have a hard time owning a company and not getting a dividend for 2 months. All right, so dividend policy all monthly. So now we look at the yield. The goal is +9 unless you can make a case for something with a smaller dividend. So the ones in light blue we own in Fidelity, and they're all municipal bonds, meaning, I mean, the goal is 9% or better, right? So on the surface, 6.5 or 7.5 sounds a lot different than 9, but when you factor in their tax equivalent yields, they're a lot higher. So they would stay on the list. Utilities, I still think the utility market is overpriced if you're not already in it. DNP it's the same thing. It's tempting, but DNP we end up with this. I need more space. DNP is pretty much always in premium territory, right? So 6% compared to 9%. So if we did it based on a dollar would be break even. For every dollar invested, you're getting a dollar. For every dollar of cost, it's a dollar of value. Um, say for 10% off, it's like paying 90 cents for every dollar invested. At 6%, you're paying a dollar six for every dollar invested. Now you can make the case, and I've made it before, right? We would look at the 1 year average. So anything under the 1 year average would be considered a good deal in the sense that you're getting it for a discount in relation to the 1 year average. However, on my end of things, I still have a really hard time buying anything in premium. Maybe if it, I don't know, maybe if it was like super low, one or two, maybe. But the other is the dividend. The dividend is insanely consistent, but it's also not rising. It's not falling, but it also isn't rising. And it's been insanely consistent over the last, I don't know, like 5 to 10 years. And that's great, but that's also not helpful because I would love to find a rising dividend. ERH used to be under uh, different company management. I've owned an alternate company before, and I'm not happy with their management. You consumer. NBXG we just talked about. It'll make the list because it might be a Roth investment. So we're taking that overall strategy, right? Bonds, bond proxies, real estate, energy transport, but it's also knowing that the overall energy market is still higher than what it used to be. And energy market like utility market, like tech market, if you're not already invested in playing a dollar cost average game, it's inflated. So you're paying a higher price for it now than what it used to be. So you're not getting the best deal for it. And we want to optimize what we're doing. Now, these have some of the higher yields, mostly US bonds, right? Still mostly US bonds. But is it better than what we have? And that's like we own three Nuveen funds here. We want to add a fourth one just because it's a straight bond and not, it's got some municipal. It's more, it's like its own portfolio in a can of bonds. Do we want to add more bonds when we already have portfolio in a can, bonds and other stuff, bonds? I mean, real estate, but they also have real estate bonds. Do we really want to add another one just because? Not really. I mean, that's diversifying across bonds, but that's where you get into over diversification. There we go. And I get it. Like they pay better yields in comparison, not by much. But I don't think that helps me. So, and then PDO, that's another, I don't know how I missed that other than it blending in. PDO is the same idea. Your Do you want to buy a premium fund or not? We already own bond funds, and I've said no to PDO in the past. I just, for whatever reason, didn't see it on this one. So that leaves us with what we already have. But that's the tilt of our portfolio. We're invested into the market based upon the current market playing the long game. And if the market shifts, I mean, I'll be honest, like I like these funds. I'm attached to them, I guess you could say in a way. I mean, there are funds we paid for them, but I like all these funds. They pay great dividends. They're great long-term investments. But if the market suddenly shifted, you have to look at your emotional attachments compared with your retirement. Or if you're going to live on dividends, right? You suddenly sell every fund in your account. Well, you no longer have dividends. You've got to wait a month until you invest in whatever and then get dividends again, right? But that's mean, in the Roth, we're investing now for later. We're not going to access the money anytime soon. Otherwise, we pay a penalty, right? But if the market suddenly shifted, you have to look at your strategy and you have to be willing to change it. I love all these funds, but if the market suddenly halved or just we hit some monumental roadblock and the market started sliding, I don't want to be a hurt investor and just immediately sell for fear. But at the same time, I would like to, if it really is going to go down, I would love to say I'd do this, but you sell it here so that as it slides, when it finally gets like it's going to settle and finally curve at the end, right? Regardless of wave, regardless of how deep it goes, that curve at the end always curves up. Now it might curve and slide further, but it still goes up. So depending on where you buy, right? I'd much rather sell it here, or I'd much rather sell it here and have money to invest down here, even if I don't buy the true curve, like through true bottom of the market. I'd much rather have a lot more money to buy here and get a fantastic deal and get it for pretty cheap. So that when it swings back up, now I have this giant gap between what I paid for and what it's worth. And the goal is a no withdrawal portfolio. But that doesn't mean we can't cycle funds. And the bond stuff, I mean, the bond stuff is easy. Like, I mean, maybe that section of our portfolio would stay regardless of the economy, right? We would either hold on to it, right, and then buy it when it got better. We'd sell part of it or sell all of it. Maybe we would hold on to the bonds, right, and we would cycle through the other stuff as needed. I don't know because it hasn't happened yet. I haven't had to face that conflict or that antagonism to this current setup. The municipal bonds, I think, stay. I mean, the market would have to sour considerably to sell municipal bonds, but I don't know. I mean, anything's possible, but that's really the difference I see in my portfolio between us actively investing, us self-directing, actively investing our portfolio compared to somebody else managing it. When somebody else is managing it, you're limited to their whims, you're limited to their strategy. And you can talk strategy with them, but that doesn't mean they adhere to your strategy. As a self-invested investor, we can pick our strategies, we can adjust our portfolios, pick a business day. We could redo our strategy over a weekend and have a brand new strategy for Monday. But as it stands right now, any of these are great options. I could argue for any of them. But what's the best thing inside the Roth? Because, I mean, fact matters. We've bought 2 rounds of Fidelity at the end of the month. We're not going to buy another round right now. So inside a Roth, so long as we jump through the hoops, it's tax-free money. So it's post-tax money going in. Any kind of business transaction that happens inside the account is tax-free, no capital gains money. So tax-free money through a municipal bond doesn't really help us inside a tax-free account as it is. And maybe you could make a case for that. And if you wanted to make the case to me for that, I'd gladly listen to you, but it just doesn't make sense to me right now. So that leaves us with what we already have. So of what we already have, what's the best idea? And I think I'm going to end up picking a top three. That's, and we can reference this. So HFRO, CIF will not make the cut. So we want to focus on corporate bonds, municipals, not for the Roth because it's already tax free. Uh, so we end up with corporate bonds, real estate, utilities, and energy transfer. You can make a case for HGLB because that's all of the above, plus some. BRW is uh, bonds and loans, but it's also closed-end fund. Like it's their own closed-end fund investment portfolio, precious metals, cryptocurrency, TEEF, which is it's a no oil. How to categorize TEEF? TEEF is a energy company not interested in oil, but interested in everything that's a derivative or offshoot of oil, which is kind of interesting. Um, but that it fits us in the bonds department, but not in everything else. It pays a fantastic yield. But if I'm going to be extra choosy, it's not going to make the list. So now we're left with four. So great dollar cost average move. You can argue for this one. I could argue for this one. But if I'm going to wait and see, it's not going to be a thing for Monday. So I wouldn't buy NBXG on Monday. Of the rest, and well, the people who follow me have been, that I like sets of 50. It's not like I like to, dabble here and there. So we could pick up 100 shares here, 100 shares there, 200 shares there, or even like 100 shares of FCO and of HFRO. I think that actually works out. The best thing, yeah, 1231 and 1260. That would still work out. So if I'm waiting on NBXG, really just to see if the price continues to slide, I would wait. If I'm going to invest first thing on Monday and not think anything of it, meaning I'm going to invest and then essentially set it and forget it and not watch it like a hawk. I mean, to be honest, I don't do these videos in advance anymore. I'd either A, look and see how that goes. B, I would buy two and buy 100 of each set. Or C, this would stay because it's what we want. It's bonds, it's energy, it's real estate, it's utilities. We already own it, and it's still relatively cheap overall. What I wanted to show you up here. HGLB is currently about $1 more than this. HFRO is currently maybe 50 cents less than this. FCO is about 80 cents more. And BXG is $1 more. So if we opted dollar cost average, it would have to be under this price because we don't have enough to buy 100 shares. So if I was going to set it and forget it and look at just the best overall face value deal, then I would do this. And I would buy those, set it and forget it. The trades would go through, I'd factor them onto the list, and then really wouldn't look at it until another week went by. Um, that's not enough. Oh, it is interesting. So here's the counter argument. Pick up 200 shares for 123. Or you can buy 150 shares and get a better dividend. Interesting. Yeah, those have a better deal than that. So it makes it look like this. Either A, yeah, this is what I mean. So my videos are unfiltered, so you get to see all this stuff. And I try to keep the waffling to a minimum, but this is an interesting thing. So HFRO has more square footage coming online, which means its overall net asset value will continue to rise. This window will hopefully shrink and that share price will hopefully rise, which the whole stock market is its own risk, ongoing roll of the dice. Bonds, corporate loans, private lending, BDC, very well set up for this current market. Now you have this portfolio in a can that does a little, well, maybe not a little of everything, but it's invested where we want to invest outside of having consumer and some tech, which that tech is just going to make it fluctuate some. There we go. So what would I do given the current market? If we're, gosh, if you're looking for just the straight dividend, you're going HCLP. But if I'm looking in general, I still like this combination. And I mean, you can make the case, right, for the better face value dividend. But FCO has raised their dividend. I think they'll raise it again. And again, HFRO with the portfolio change between bonds and now real estate, as they get more square footage online, this number will go up, that number will go up. And then my hope is that their dividend comes back. Uh, so yeah, so I would still do this. I would still pick 100 of FCO and 100 of HFRO, and I would call it a day. So, gosh, so much content, so much info this time. So if you like the content, consider subscribing to my channel and hit the like button because it really does push videos out. And for everybody who wrote me a comment, for the one guy who found me on Facebook, for the few people that left me messages on YouTube, thank you very much. And I hope I answered your questions. And I realize I still haven't given you the full system on closed-end funds yet. Please be patient with me. Please keep reminding me. Uh, it is a work in progress. Uh, but for the other stuff you asked for, the portfolio update, the strategy update, uh, really a lot of what we covered at the very beginning, maybe the first 30 minutes of what we haven't been covering, at least in the last month or two. Um, so if that answers your questions, let me know. If you still need more info, ask whatever you want to ask. Let me know that as well. If you want to find me day to day, either comment on this video or find my Navigate Your Finances group on Facebook. And of all the other financial advice floating around out there, just remember everybody pushing manifestation. Manifestation might make you feel good, but it's not going to solve all your problems. And it's certainly not going to make you do anything. It's going to make you think a lot and mellow out, right? Think this, repeat that, and then maybe have that pop up in your life. If you want to do something different, you cannot simply think about it and manifest it. Okay. If you want something different, something more, then get out there and do it. Make it happen. Don't sit on your laurels. Don't sit on your ass. Get out there and change what you want to change. So, whatever you have for the week, I hope it goes well. This is Daniel Young signing off, and I will see y'all on another video. Have a great week. Bye bye.